Welcome to the Legally Ever After Real Estate Podcast, where we help you build, protect, and pass on your assets. I'm your host, estate planning attorney Pamela Moss-Garrett. Let's get started. Today we have Ryan Campagnola from Synergy One Lending, and he's going to be talking to us about generational wealth with real estate. Welcome, Ryan.
Hey, Pam. I really appreciate you having me on. Thank you.
Absolutely. So what are some ways that you recommend creating generational wealth with real estate, especially in today's market?
Yeah, appreciate again the time and really excited to talk today. So a big thing we're seeing right now, the biggest trend I would say is really is based off of what we saw the last couple of years with, all-time low rates during the COVID environment, 2020, 2021. We saw rates drop to rates we'll probably never see again, historically lows. And so with that, majority of Americans were in a spot where they refinanced their property. Right now, I think I saw the stat that 63% of mortgage holders have a rate right now between 2.5% and 4%. And when you compare that with current market rates, right, in the mid sixes, that's, a stark contrast. At the same time, 40% of homes in America are owned free and clear. And then with all-time home prices, with a shortage of supply and all-time high prices, we're seeing people with tons of equity, whether that property is free and clear or they've had that home for a little while. They've built a tremendous amount of equity. And if they do have a mortgage, right, with those super low payments, they've got a really affordable payment. And now people are just trying to figure out, hey, how do I leverage that? Leverage that property, all the equity they built to their advantage, whether that's, keeping the property and improving it or going to buy something new.
That's a great point. And the 40% free and clear is really interesting because I was just reading a statistic today about, we're in the great transition of wealth in our economy from the baby boomers to the millennials. Like the majority of wealth is going to transfer over the next 2 decades. So it doesn't surprise me that 40% being free and clear is that mainly the baby boomer generation that owns everything free and clear for their percentage.
Definitely. Yeah. I mean, typically when I'm talking to a borrower that has a property free and clear, they usually, skewed in that 60, 70, 80 year old range. It's rare if we ever see someone, much younger having a property free and clear. Usually there was some sort of, liquidity event that allowed them to pay off the mortgage. You think about, I think we've heard it called the silver tsunami, right? All that money that's going to be passed on. And a lot of that wealth, the majority of Americans' wealth is typically in their home. So on that topic, we're also going to start to see, I think, a lot more reverse mortgages come into play in the future, just with most Americans having their money tied up in their property, but maybe needing access to it. We're also seeing a lot of HELOCs being leveraged right now, just with that all-time high equity. And with low rates, people don't want to do cash out refis and cash out the whole thing to these higher rates. They want to, pull a HELOC out, leverage that equity at a lower rate. And then if you look at their combined, between their first mortgage and their second mortgage, kind of what that blended rate is, it's much lower than if they were to actually pull out cash out today.
So when we're talking about HELOCs, what's the best use for a HELOC? The smartest for creating that generational wealth?
Yeah, so I'm a big fan of HELOCs. It's one of the things I always talk about with my clients is, whether you're looking to do something, whether it's, pop a top, add an ADU to the property, do some renovations or go buy something new. I think, it's always a great time to have a HELOC open on your property, especially with the amount of equity most people have currently in America. One of the big things I like about a HELOC is it's a great emergency fund, right? A lot of Americans, the stat, I don't know exactly the numbers, but they say they're one paycheck away, or they're living paycheck to paycheck or an emergency fund. They might not be able to cover if, they had an emergency pop up. But with a HELOC, it's a great way to have that open line of credit where if, you had a major emergency financially, you could cover that. I'm also a big fan of using it to consolidate high expensive debt. We're just coming out of the holidays. A lot of people accrue lots of debt towards the end of the year on credit cards. That interest can be very high, like in the 20s or the high teens. And if you compare that to HELOC rates, even though they're higher right now with the Fed raising rates, it's still a great way to consolidate high interest debt to a much lower debt cost, especially because you can pay interest only on most of these HELOCs. Additionally, if people are trying to leverage that money from an investment perspective, we're seeing a lot of our current clientele opt to pull out HELOCs to either pop the top, add an ADU to the property, or go buy additional real estate with that equity, right? Whether that's a new primary residence, a second home. Maybe we're here in Denver, so up in the mountains, a lot of people are going to buy up in Breck, Keystone, Vale, or go buy a new true investment property. So yeah, we're seeing a lot of creativity right now with people wanting to leverage that equity in their current home. And the best way right now, just with the higher interest rate environment we're in, is to do a HELOC and then look at that overall blended rate between their existing first mortgage, which is probably super low, maybe around 3%, compared to if they were to pull out a true cash out deal today.
So there's a few things that you mentioned there that I just wanted to touch on. The first thing you said was, or one of the things you said was, with a HELOC, you can do interest only. And so is when you're kind of calculating what your payment's going to be on that HELOC for money that you take out, can you kind of give more information about what you mean by interest only and why, what we might expect if we're looking at doing that type of finance?
Definitely, yeah. So yeah, most HELOCs, if you go to your local bank, you're going to typically see a traditional HELOC is a 30-year term. For the first 10 years is your draw period, right? So that's your draw period where you can draw on that line of credit, that home equity line of credit. And typically that first 10-year period is interest only, right? So the advantage to that is it's a much lower payment than if you were to pay fully amortizing principal and interest, especially in the higher rate environment right now. The other advantage with that setup is a lot of people are like, hey, I'm going to keep this property for a shorter period of time. Let's just pay the smallest amount I can, that interest only payment, and then when we go to sell it, we'll pay off the full principal amount at that point in time. So we're seeing a lot of creativity on that as well. But yeah, traditional HELOC in the most basic terms, you're usually going to see a 30-year term, with the first 10 years as interest only, and that's also your draw period. And then the remaining 20 years after that introductory 10 years is your fully amortizing payment when you're paying principal and interest. However, most HELOCs, you have that ability to pay principal and interest at any time. And you have that ability to kind of draw up and down up to that credit limit.
And then is there a certain percentage of what you're eligible for a HELOC? So say you have 100,000 in equity. Is it like 1/3 that you can take out a HELOC on, or how does that ratio work?
Yeah, so typically, lenders, when we're typically going to evaluate, how much a person can draw on a HELOC, they're going to look at what's called the combined loan to value. So they're going to look at the existing first mortgage compared to the value of the property, right? So we call that the loan to value. So let's say that someone had a property worth $1 million and they owed 500,000, right? We'd say their loan to value is 50%. A lot of banks are going to go up to the max. The tip top would be 90% combined loan to value, which in that example would mean that the person could pull a $400,000 HELOC at the max, because 500,000 plus 400,000 would be 900,000, which would be that 90% loan to value on $1 million. A lot of banks, they cap their HELOCs. Maybe they'll max out at 400 or 500,000. They might again have restrictions as you get into the upper echelon, but in general, most banks are going to either max out in the 80s or in the 90% or maybe 80% combined loan to value on a HELOC.
And then what are the typical interest rates for those right now that you're seeing?
Yeah, so most HELOCs in general are usually going to be based on the prime rate. So when you hear a lot of times talk about the Fed raising rates, that's short-term rates. A lot of times we're going to see the Wall Street Journal prime rate go up. So right now that's 7.75%, right? Every time you hear the Fed say, hey, we're raising it, usually we're seeing that Fed or the Wall Street Journal prime rate jump up. It's different. The federal funds rate is different than the Wall Street Journal prime rate. So I want to make that clear. But a lot of times we see those go up in lockstep. But yes, right now, right around 7.75 is prime. So a lot of times on HELOCs, when you're getting approved, the lender might say, your rate's going to be prime or prime plus 1 or prime minus a half. Or, we're seeing even some, local banks that are offering introductory rates for the first 12 months where it's maybe prime minus 1. And then after that, it goes back to prime, which kind of that nice period of that introductory 12 months is as inflation comes down, which again, we're starting to see signs that maybe inflation's peaked, is that as those rates come down, it'll put the HELOC in a position to also come down and make that more affordable. But that introductory rate gives you that lower rate to start to kind of let inflation work its way down and rates come down.
And can you refinance your HELOC when rates change and when equity changes?
You can. The other thing we see a lot of is we do a lot of debt consolidation where maybe someone's got a first mortgage and a HELOC and they want to consolidate them, right? So during that, COVID environment, 2020, 2021, people that had a first mortgage and a second mortgage, we did a lot of refis where we'd consolidate the first and the second. Maybe you had your mortgage, your first mortgage at 5% was a rate. Maybe you had your HELOC also at 5, but we could refi and consolidate. Maybe your first mortgage was at, again, 500,000, and maybe your HELOC was at 100,000. So $600,000 worth of debt at 5%. If we could consolidate that first and second together and refi that down to 3%, right? They're saving 2% interest on that total amount. So I think, again, once we see inflation subside and come down, and as we see rates come down, people that have HELOCs right now, they're opening up these higher rates, or if they took out a mortgage at the higher rate environment right now, we're going to see a lot of people either consolidate or have an opportunity to refi at much lower rates and a much lower payment.
So I guess kind of one of the examples you did was, popping the top, adding another level, or doing like an ADU, an alternative dwelling unit. And so if you're going to add an ADU, I guess the analysis you'd probably do is like, okay, it's going to be a couple $100,000 to do that. What is that going to raise the value of my home compared to the interest I'm going to be essentially paying the bank for the money to do it?
Definitely, yeah. So I actually just had a recent client where we kind of did exactly that, where their property was zoned where they can have an accessory dwelling unit on the property. We looked at, okay, what's the cost going to be to build that? And then, yeah, what's it going to cost them financially versus, their plan with the ADU was to be able to short-term rent it. So, they had an analysis done that says, okay, if we have this property and we build it to the specs, what could we, potentially short-term rent it for? And what could be cash flow versus what's it going to cost us from an interest perspective, whether that's interest only or fully amortizing? And, are we going to be net positive, right? And so for this client, it was the case where, even with the HELOC they were pulling out, what they were going to be cash flowing made them profitable. But that's something we'd want to do the analysis on, whether it's an ADU, a pop top is, trying to find that best option. Another example, I had a person in the Wash Park area. Obviously, we know it's a very valuable area, usually smaller homes. So you see a lot of those places either scraped or pop the top. Had a client that, before we saw rates really climb last spring, that I advised them to pull out a HELOC instead of do a cash out refi. And we actually set them up with a fixed rate HELOC. That way the rate didn't go up as rates went up. So that's one thing to make a point of is there are HELOCs that are fixed rate and there's also HELOCs that are variable rate. So for that client, we recommended a fixed rate HELOC. That way he could avoid potential increases in rates over the last 12 months. And yeah, they're in a spot where they're almost done with their pop top. And yeah, their blended rate, is much, much lower. It's in the 3s between their first mortgage and their HELOC, versus if they were to have done a variable rate, they'd be much higher on that blended rate.
Wow. I know. It's like everyone should have done that, right?
Yeah, hindsight's always 2020, right? I mean, yeah, if I could go back in time, I would have, tried to blast out an email to every client to say, hey, now's a great time to lock in a fixed rate HELOC, have that super cheap debt that you can draw on. But, no one, I think, expected, inflation to go up quite as much as it has and the Fed and rates to go up as high as they have to try and slow inflation. So, yeah, hindsight's 2020.
If you sign everything for your HELOC, you get approved, and then you don't actually take out any money against your HELOC, is there like you're using it as an emergency fund or just in case, or maybe you're going to do it on an investment deal and it doesn't work out, or you find better financing option? Do you still get fees and things like that keep coming? Do you end up having to close it? How does that all work?
Yeah, it depends on the bank. So some banks have like a yearly fee to keep that HELOC open. Sometimes, if you're drawing on it, they won't charge you that fee. Other times, it doesn't matter if you draw on it, they're still charging that fee. Usually what we see is a lot of times they'll charge no fees up front, but then they'll charge an early closure fee if it's closed within a certain period of time. They also a lot of times will try and incentivize you to draw money at closing. So they might say, hey, if you draw more than 10,000 at closing, we'll take a quarter point off your rate. So it really depends on the bank. Like at our company, Synergy One Lending, we have a fixed rate HELOC product. But we also, have some broker products where it's kind of that more traditional HELOC. So really, when I talk to a client, we're trying to figure out what that goal is, right? Are they doing home improvement? Are they popping the top? Are they doing an ADU? Are they drawing on that equity and then moving and buying a new place, right? Also, the other thing to consider is what's the payback period? Like how quickly and how aggressively can they pay it back? Or are they going to be not aggressive, right? So a lot of things to consider. when kind of evaluating how do you want to structure it, and then what, who we want to broker it through, to kind of get them the best terms and setup.
And then you have some tips of things you should not do with a HELOC. Is that right?
Definitely right. So again, I was not in the mortgage industry during the last financial crisis, 08, 09. But at that period in time, right, a lot of people were pulling out HELOCs, are also referred to as second mortgages on their property, and they were buying boats, right, or taking lavish vacations. And, not to say not to do that, right? But you don't want to treat your home like a piggy bank, right? Especially if you don't think you can actually pay that money back, right? And back in 2008, 2009, it was, again, I was not originating at that point in time, but it was a lot more of the wild, wild west. If you had a pulse or if you could fog a mirror, they could give you a loan. Now it's much more stringent and strict. But I think the overarching theme still applies is just because you have that equity doesn't mean you should use it, willy-nilly. You got to be, again, putting it towards either, I would say consolidating expensive debt, right? Saving yourself money on interest, using it as an investment, using it as an emergency fund, but not, using that money towards something that, potentially is not going to cause a return on investment or ultimately benefit your financial balance sheet as a household. And don't put yourself in a position where you're, in over your head or over your ski tips and you can't pay that money back. So yeah, big, thing I'd like to point out is don't treat your home like a piggy bank.
Is there a certain amount of equity minimum that you should have before you even consider a HELOC? Like, are you saying are HELOCs best if you have like 100,000 more or more in equity versus like 25,000? Is there any good rule of thumb?
Yeah. So in general, I mean, most of the banks won't even look at a property unless, you've got at least 20% equity, right? So you always kind of hear the gold standard, 20% down, right? Most people don't realize you don't have to put down 20% to buy a home. You can do, much less. But when you're going to look at a HELOC, most banks will not entertain or even, give you the opportunity to look at a HELOC if you don't have at least that 20% equity, right? Because if they're going to max out at 90% combined loan to value, that would only give you a HELOC of 10%, right? If you're at 80% currently and you want to draw another 10, that might be a very small HELOC depending on the value of the property. So yeah, in general, I would say right now, most of the HELOCs we're originating or brokering, we're seeing positions where the loan to value or combined loan to value is well below like even 70%. So, the nice thing is I think a lot of people are being, conscientious or smart about not trying to max themselves out. And they're being more direct about, hey, what is that money actually going? And I would say a majority of what we're seeing it used for is, hey, let me keep that current home, keep it as a rental. I've got a super low rate on it. Maybe the rate's at 3%. Rents are really high in the Denver metro area. I'm going to keep this property as rental, rent it out, cash flow. It's going to cover my mortgage and cover the HELOC. I can use that HELOC, go buy a new property, go live in it, put a little money down, right? And that's how, again, you can build that generational wealth is you do that a couple of times, right? You continue to go buy new primaries. You can quickly be in a position where you've got multiple rental properties, where you're cash flowing and including rental income at the same time those properties are appreciating. You get the tax benefits. So it really can put you in a position where pretty quickly you could, have it's like real life monopoly, right? Where you've got the properties all around town and building that money coming in every month. But you also have to do it smart, right? You don't want to get it over your head and put yourself in a position where if things don't go well, you can't cover those payments.
And then is there any kind of guidance that you have? So we've talked about, if you're going to do it, buy a new primary, you can also go and buy an investment property. Any thoughts about, using it to purchase a second home?
Second home, like vacation home or just an additional property?
Yeah, whether it's, a short-term rental, or if you're going to use it for just a second residence.
Yeah. So I would say, it really depends on what the ultimate goal is, right? So maybe, you're really happy with your house, but you're like, hey, we've got a lot of equity and home equity is very illiquid. So it's like, hey, how do we tap into this and put it to work? Maybe if you're happy with your property, but maybe you're sick and tired of sitting in traffic on I-70, go to the mountains. You're like, hey, let's go buy that home in the mountains, buy that second home. We'll occupy it. We'll use it, go skiing, but we can also rent it out and make some money on top of it, right? That's a great, option and something we see a lot of. Maybe you're not happy with your home, right? Maybe you have a growing family. Maybe you're pregnant. You're like, hey, we've got more kids. We need more rooms. That's a great way to say, hey, let's go buy that new house. maybe you can tap into the equity of your current place via HELOC, right? And maybe if it all works out from a numbers perspective, you can keep that place as a rental, go buy the new place, and that rental, right, someday when it's paid off, that could pay for that kid's college, right? So again, it's building that generational wealth there. And I've got some clients where they've now got 10 properties or more. And, some of these are free and clear. And they're like, the cash flow through this, they're able to put their kids through college, right? Or, hey, now we're going to leave these properties to their kids or grandkids. So, that's definitely my goal, is to trying to continue to acquire properties. And honestly, from a lender's perspective, the easiest way to do that, from a true cost of capital is to typically go buy that new primary residence, right? Because on a new primary residence, in general, you're supposed to be putting down that, as a minimum, like that 3 to 5%, unless you're in that jumbo range. But, if you compare that with an investment property, right, that sweet spot's typically 20 to 25% down. So much more, expensive from a capital perspective. So, one of the things a lot of people talk about is, hey, go buy that primary, live in it, build that equity, improve it, or if you've heard of probably the BRRRR method, right? Buy, renovate, make it nice, refi it, and then, go buy the next place and redo it. So we're seeing a lot of that, especially with the rates being so low. People have these great properties, super low payment. They can cash flow with a high rent environment, and they can go buy that next property and continue to kind of repeat that process.
Well, this is super helpful, Ryan. If someone is looking for a lender to work with for a HELOC or a refi, what are some things they should look out for?
Yeah, I'd say the big thing where is if you're going to do something more complex like this, is just make sure you're talking to someone that's well versed in the ins and outs of it. There's a tremendous amount of mortgage lenders out there. There's local banks, there's credit unions, but each bank might have a different kind of product that they really excel in, or different experience. At Synergy One Lending, we're really well versed in complex situations like, hey, I've got multiple properties, or I'm self-employed, or I want to leverage this equity. How do I best do that? So yeah, I think when they're picking out a lender, it's important to find someone that's well versed in what they're wanting to do. There's riches and niches, and maybe a lender's really good with VA clients, right? That might be a great fit to find someone that just does VA. So I think it's finding someone that's well versed, and at the same time, making sure you're talking to someone that's got competitive financing, right? Plenty of banks out there. You can see all different rates, all different types of products. So working with someone that has options, for different products and can kind of shop for different investors, I think is huge.
Yeah, and testimonial for you, Ryan. You've always been really great with the people I've sent to you. And this last tax season, as a business owner, I was trying to kind of figure out that balance. And so I was chatting with you about some options at the end of the year during the holidays. So I really appreciate all the great work you do.
Thank you. Real quick PSA on that. Sorry to interrupt, but if we are in tax season, right, we're coming up to April and people filing taxes, or if a lot of people self-employed extend October. But if you're thinking about buying this year or next year, how you file today matters, right? I can't tell you how many times I see it, someone self-employed or even not self-employed, and they file their taxes how they shouldn't, or they write everything off, especially if they're self-employed. And then they want to buy a house, right? The perfect property pops up. And we look at their tax returns, we're like, hey, effectively, you wrote off everything. You showed the government you made no money. And it's great because they paid no taxes, but at the same time, now they can't qualify. So if you are thinking about buying, whether it's me or any other lender, get in touch with your lender before you finalize those tax returns. That way you can make sure you're not setting yourself up to be very unhappy when that perfect home pops up and you can't buy it because you didn't show any income on your tax returns.
Yeah,
so,
absolutely.
Sorry, PSA.
No, that was perfect. And it was so helpful because I was doing that dance with my tax lawyer at the end of the year, and we were trying to decide certain things. And we want to get a bigger house at some point for our growing family. So being able to run it by you is really helpful. For people who are interested in working with you, what's the best way for them to reach out to you, Ryan?
Yeah, so I'm happy to share my contact information. My email is just rcampagnola@s1l.com. And my cell phone is 303-552-8264. So I have people text me, call me, email me. Usually, really responsive on all three different methods. But yeah, I'd love to help anyone if they have questions or want to run through scenarios. I'm always happy to be helpful, try and help them in any way I can.
And are you focused on working with people in the state of Colorado?
Yeah, so I'm licensed just for the state of Colorado. However, our company, Synergy One Lending, we're licensed for all 50 states. So this last year, through my team, we have a loan officer that's licensed in every state. We were able to help, several people in other states. So yeah, if it's something that, someone needs to buy out of state, we've got a team member that can help lend in all 50 states.
Oh, wonderful. And my final question that I ask everyone, Ryan, is what is your legacy? What is the legacy you're building?
That's a loaded question, but yeah, I think my legacy, obviously I love finance, right? I'm in the mortgage industry. No one dreams, growing up to be a mortgage lender someday. But one of the things I really love doing is empowering people to, make, the right financial decisions, whether it's, buying a house or even, buying that first car or figuring out how to optimize your credit cards, right? I always joke that we all know, the cell wall of a plant, and we learn bio, and we learn trigonometry and sine, cosine, all that stuff in high school, but never taught any personal finance skills, right? And it shows, right? When I talk to people every day, there's a lot of stuff they're like, wow, no one ever told me that, or I wish I would have known that, 5-10 years ago. And I feel the same, and I have a finance degree. So the legacy I try and build is, every client I talk to is, try and educate them as much as possible and really show them that I care about, helping them build that generational wealth. A running joke in the real estate industry is, a lot of millionaires are built off of real estate, and it's usually the most uneducated millionaires, right? Compared to maybe people in tech or engineering. But it's a great way that, yeah, if you do it right, you can build really good generational wealth. But you got to have, the right attitude and also have the right background, financially. So yeah, the legacy I want to build is empowering clients, helping people, and then, at the same time, doing the same thing for myself.
Wonderful. Well, thanks so much, Ryan, for being on.
Definitely, I appreciate the opportunity, and yeah, really appreciate you and how you've helped my family, Pam.
Absolutely.
If you need an updated will, trust, or estate plan, and you are a Colorado resident, we would love to be your estate planning law firm. Give us a call at 720-706-0036 to schedule your complimentary 15-minute call. You can also directly schedule at lawmother.com/go. If you liked this episode and you want to learn more, you should definitely check out my international best-selling book, Legally Ever After. It's available on Amazon as both an ebook, a paperback, and an audio version. And if you'd like a free chapter, head over to lawmother.com/LEA.